Hello, folks. Welcome to the Two Stewards show. My name's Mark, and I'm here with
Brent.
And we're going to talk about... What are we going to talk about today, Brent? Private equity?
I haven't had lunch yet. I don't know. You probably hear my stomach rumbling in the background this time.
Yeah, it's not an earthquake. It's just Brent's stomach.
Yeah, today we want to talk about, I think, a little bit alternative real estate investing strategies or methods, because for a while in this podcast we've talked a lot about how can an individual person buy a house, and some of the reasons why you might want to do that, and then some of the benefits that offers, and that's a great investment thesis, and we'll continue to talk about that a lot and in all different angles for everybody. But one thing I think that keeps coming up in conversations with people is different investment strategies outside of just regular home ownership or buying a rental property. And there are different options. So we want to talk about them.
Yes. So, one popular one is joint ventures.
Yeah.
And we're not going to talk about that today, really.
No.
But we'll maybe the next... No, that'll be, I think, a separate episode. But today we want to talk about. We say private equity. I mean, that brings to mind a lot of different things.
Yeah.
So you could think of like a REIT, for example. That's not even really private equity, but it is an alternate real estate investment structure. So that's a real estate investment trust. And I don't know. When I think of them, I always kind of think of like a mutual fund.
Yeah.
Really, it's a big pool of money that people put in, and I'm not, big on REITs necessarily as a real estate investing structure. Some people will buy a REIT because they want exposure to real estate. That's great, but you're not really getting the benefit of leverage for one.
Yeah.
You may get the benefit of the performance of a company that is exposed to leverage, but it's not the same thing as directly buying a house for 20% down and then getting 100% of the benefits. So a REIT is one. We're not really going to talk about that, but that's an alternative to alternative investing, real estate investing structure. But it's like a very passive type, right?
People will put their money in a REIT, and usually you can kind of pick a REIT that has a risk tolerance or a level that you're comfortable with, and you own shares of it. It basically a publicly traded company that issues shares, and they hold the assets that they're investing in, and they do all the management, and then you just as an investor, you would buy a portion of that, like shares in that company, right? And then you just get returns on those. We're not talking about that. Okay, what are we going to talk about?
And then you've got BlackRock, right? People talk about private equity. We're not really talking about that either, right? Like these giant investment firms who are not publicly traded, so that makes them private, essentially. But you can't really buy into BlackRock unless you're like a wealthy individual, and you've got lots and lots of money to invest, right? But not for the average person. Crowdfunding, so that's an interesting one.
We definitely should do some more deep dives on crowdfunding. But
So Addy Invest, I guess, is like the one that really comes to mind. And they do, real estate crowdfunding. So you can invest generally up to $5,000 per deal. And so this is why it's popular for...
And as little as like $1 or whatever.
Really,
really small amount.
Yeah. Yeah, so it is a super cool idea, and there's a bit of an ideology behind it, right? Where they want to make real estate accessible to everybody. Yeah. And so, that's really cool. But if you're an investor with a larger sum to invest, then, it's not really going to work for you, right? If you're a younger person and, you've got some capital, you like a couple grand that you want to invest in real estate, then this is perfect because you're getting the benefits of leverage and because you're buying a piece of a property.
Yeah.
Right. So there could be, 1,000 people in on a certain and that's how they do it, right? They will have a deal and then you invest in that deal. You're not investing in the company. You're investing in the deal.
Yeah. And your funds aren't spread across like all of North America and all the assets that company owns. It's just one particular deal. And so you better believe in it. Or at least do your due diligence and make sure you're not making any mistakes. But so we don't want to talk about that.
We are talking about it, but we don't want to. Well, and then you got MICs as well. I forgot to mention that, but a mortgage investment corporation. So a lot of people will do either private mortgages or invest in a company that does mortgages. And we've seen some good and some bad mix. You have to do your research before you put your money into one, basically, right? I think there's that one in Saskatchewan. I don't know if it was set up as a MIC, but I think it was, where it was just a shambles. And eventually it fell apart. And they had...
all of Saskatchewan fell apart? I never heard about that.
You didn't? No, they sent in the army and they rebuilt it in a day.
Okay. We now have no listeners from Saskatchewan.
I don't know if we did. No, it was it was an investment thing, and it was just terribly run. Yeah. So it was almost like a Ponzi because they needed new money to prop it up.
Yeah.
Because a lot of the properties that they bought, so maybe this wasn't a MIC because they weren't doing mortgages, they're actually investing.
Syndication or something?
Yeah, syndication. That's what I'm thinking of. So there's another one, right? Yeah. Syndication. We're also not talking about, well, I guess we are kind of talking about syndications. So really what we want to talk about today is the GPLP structure.
Yeah.
In real estate investing.
Yeah.
So, we're coming from the angle of the smaller real estate investor who's buying residential real estate, right? You've got commercial real estate. We're not experts about that. We're not going to talk about it. But residential real estate investing, this is a more popular, I think after the joint venture, then you get into, especially if you're doing some bigger deals, the GPLP structure. So
so this is something that people might not be aware of if you're just going about your life and doing your thing. But for a lot of bigger investors and bigger family offices and people who have quite significant amounts of capital.
It's a family office, Brent.
I don't know, but my family doesn't have one. So people who work for people just managing all their money because they have so much.
Yeah. Okay.
That's the way I understand it anyways.
Yeah.
But then you look for ways to deploy your money more into projects without being an active manager, but still having an ownership stake and having a say in that particular job or project. So the GPLP structure you mentioned is kind of the model that is most commonly used, right?
Yes.
GPLP, what does that mean?
Oh, I thought I was asking you the questions.
Oh, okay, well, you can ask me questions after that.
Oh, okay, fine. So GP is the general partner, and you can think of that person as the active investor or the active person in the relationship. So, if we keep it real simple, let's say there's two people, one's the GP, one's the LP. Normally they're bigger deals and you've got more LPs, but we'll just say 1-to-1. The LP would be the passive investor who is generally just bringing in cash.
Yeah.
And there's so many different flavors and ways that you can do this, and often LPs will have different things to contribute, and probably that's a good thing to look for in a relationship. A financial relationship of this sort, right, is where you have LPs who aren't strictly just bringing money, but they're bringing some sort of expertise as well. Doesn't mean they're operating partner, but...
So just to make it real for people, okay, so this is actually a pretty exciting strategy. Make it real. Yeah.
Okay.
So if you... let's say you have an investment thesis. I think this is where it all kind of starts, right? Because a GP or a general partner, they're going to be people who are in the industry, real estate investing, developing. They're going to be kind of boots on the ground people, financial people, figuring out, what is the strategy here? Like, they're going to do their research.
Yep.
They're generally, hopefully, right? You're going to find people who do research. But they're going to go out there and they're going to build a philosophy of like, why am I going to do this investment? And how am I going to generate returns? Where are the opportunities? And they're going to find and highlight them and actually, do all the work to make the investment actually happen, right?
And typically they are specialized in one kind of deal or one subset of real estate. So it could be like storage units, it could be strip malls, it could be residential properties, like multi-unit, whatever.
Like it could be conversions of one kind or another, like converting this into that, or even student housing. I've seen a couple opportunities where we develop purpose-built student housing in this particular niche area by this university, right? And so like all different property types this can apply to, but typically speaking, the general partner would be somebody making an investment thesis, or I guess you could say like a philosophy or a strategy around why would this be worth investing in? Yeah. And how would my skills as a general partner make this deal work and be of benefit? And so what's exciting about this for maybe listeners or people out there is that as a limited partner, we can participate in these projects and like both invest our money, but also participate in like whatever investment philosophy or strategy they're employing. And then we can reap the rewards, right? So if it's financial rewards, obviously it's a huge portion of it. The other portion of it is like, I do want to see more student housing being built in this area, so I can put my money towards that and see the benefits. So that's a cool, definitely a cool strategy that we want to chat about.
Well, and you also get the benefit, especially if you're newer, of learning, right? If you want to get into, let's use student housing as an example, right? You want to really get into that. Well, you could like risk your capital and your time and like do it yourself.
See how they do it.
But I would much rather learn from somebody else. And maybe you don't make, the reward isn't the same, but the risk isn't nearly there either. And if you're going to get into something, learn from somebody else who's done it. I know I've done enough banging my head against the wall trying to figure out how to do something when I should have just gone to somebody else and like asked or
I couldn't done tell, a partnership. Your head's pretty nicely formed there.
It's got a callus. Oh. I just polish up the callus.
That's why the hair doesn't grow. I guess it just comes out the bottom. The beard.
But I think a lot of people in real estate do that, right?
Yeah.
Until they realize like, oh, you know what? I should just do a joint venture or like a limited partnership with somebody
to learn.
Yeah. And I guess one thing to bring up is, why do you need this structure? If you're such a smarty pants and you know how to do all this stuff, like just go do it, right? And the answer, I think, is capital. Because every investor in real estate eventually runs out of either capital or the ability to finance more investments. And, if you don't, good for you. But typically you're doing more deals. And so you've got money tied up in existing deals, or you're going to bigger deals. You just don't have that capital, but you have the expertise to make these deals work. And there's more people out there with money than there is with expertise.
Yeah. Yeah. And it takes a bit of a diversity of expertise too, when you talk about some of these bigger development projects, especially if you have resources in-house and you're doing some of the engineering or some of the, development and planning work, even acquisition related stuff in-house, then you're gonna add a lot of value just by having all those resources, right? And it takes capital, but also takes a lot of different skill sets to make a deal come together successfully, right?
Yeah, and often those aren't together. There's a fellow, Chris Power, actually I follow on Twitter, and he does excuse me, like brownfield development, and I think a lot around the Texas area. So they'll take like a Class C industrial asset.
Whoa.
And
brownfield, Class C, I don't know.
It doesn't matter, but they'll take kind of like lousy industrial land and turn it around, make it into something good, and then either operate or more likely resell it. But this is an example of he's got an office. So he's got people on the team who do like the finance part. He's got, the architects. He's got all these people that do all this stuff. The thing they don't have is like billions of dollars to do this.
So this is where this comes in, because if you have these firms out there who are doing this, or if you have deals and opportunities out there, and they're adding a lot of value, they also need to get paid, right? And that's where this whole deal structure comes in that we kind of want to delve into a bit. The general partnership, limited partnership structure, and how that kind of works, right? Because they need to get compensated at some point, right?
Yep.
And how does that all work?
Well, I mean, there was a song that was popular when I was, maybe I won't say a youth, but younger.
Yeah.
TLC, Don't Go Chasing Waterfalls. I don't know if you're familiar with that one, but you can Google it. But in this case, you want to actually chase waterfalls, right?
Okay.
So what's a waterfall, Brent?
Oh, man.
Okay, let's talk about GPLP first.
Yeah.
That sort of structure. So we kind of know what a GP is. That's generally the person with the expertise. They're going to operate it. They're going to have their boots on the ground, right?
Yeah, and the limited partner, so they're usually just supplying funds. They invest in the project, and as such, they have like a limited role in the project, right? So they're not really in a decision-making role. Usually the general partner is the one making all the decisions, right?
Yeah.
A lot of the ones that I've seen is the general partner comes with a project already, right? So they have a particular property. It has a particular plan in place. Sometimes the general partner might say, look, like we have this property, we're going to do this. Let's just make it tangible. So, we have a single family home. We're going to convert it into a townhouse development because it's a big lot. And we've actually done all the approvals with the city. So we have permits and we have, our financing in place. We just need a lot of money to make this happen. Who wants in, right? And so at that point, they need to raise money and they go to limited partners, and limited partners can come in with funds. And if they believe in the overall investment thesis and they believe in that particular project and that deal in that area, and they stand by the management of the general partnership, and they also, it aligns with kind of their personal investment goals. Like they might be looking for cash flow, they might be looking for a certain exit strategy and a certain timeline, right? With a certain return, then they would make that investment and they become the limited partner.
And typically this is all stuck together in a corporation, right?
Yeah.
You form a corporation specifically for this asset, like a limited liability if you're in the States.
And just maybe one caveat before we dive into even more, but usually these kind of structures are limited to accredited investors.
Right.
And that is in Canada. You can just Google what an accredited investor is because there's a long list of things, but needless to say, you need to have a certain income or a certain amount of assets.
Is it $3 or $4 million of assets, I think, and then $200,000 or $300,000 of income.
$200,000 of income for the last 2 years, or $300,000 of income combined with a spouse.
Yeah.
For the last 2 years, I think. Yeah, the various check boxes that if you check one of them, you can be an accredited investor. But basically, that is just to say, look, you are accredited, meaning you are financially at a point where you making this investment, you know the responsibility you're taking on, and if things go south, you are going to be...
It's not going to ruin you.
Yeah.
You've also got eligible investors too, right?
Do you?
Yeah. So, and that's a lower bar to hit, and I can't remember all the all the things, but like $125,000 of joint income.
Yeah. And so some general partnerships too will have criteria like friends and family can invest in this deal.
Yeah.
Even if they're not accredited, or if you do and you're do invest in this deal and you're not accredited, you would have to invest over a certain threshold, right?
Yeah.
So you have to put in over $100,000, over $150,000. Yeah. That's a big yawn, Mark.
Sorry.
Did you have your lunch?
Yeah, that's the problem. Had some sugar. Now I'm crashing.
We need to have guests on this podcast so we don't have to do all the talking.
I know. Okay, so that's sort of the GPLP structure.
Yeah.
General partner, limited partner. And then what do we want to talk about? Oh, waterfalls. I got distracted. But once you have that, so, and I guess there's two things we could look at, two structures. One would be an operating structure, and one would be
like a capital distribution.
Yeah. So basically that means, are you just going to hold the asset and operate it and get cash flow?
Yeah.
Or are you...
So let's just differentiate this for people.
That's a big word.
Yeah. Ooh. So when you're investing in just a single family home in a neighborhood and you're buying it, you're going to be entitled to all the benefits from it, right? So you're going to go get a mortgage and buy this house. And then if you get rent, you're going to use that rent to pay the mortgage, pay any expenses, right? And then anything left over is yours. And it's kind of pretty clean and tight. You can calculate your return on investment because you can say, I put in this much money and I got this much out of it. And it's all going to one person. And you start introducing like a joint venture partner, or let's say mom and dad co-sign, or you co-sign for your kids. Then it becomes a little bit more complex, but the numbers are still there, right? You have the money came in, it went to this person, he put in that much, so we're just basically taking that kind of mindset and we're scaling it up to like a little bit larger scale, right? So you usually have a larger project that requires more capital, and that requires more capital, meaning you probably are going to go to more people, right? Because one person having $2 million to put in a project is going to be tougher than 10 people with 200 grand.
Well, and sorry, just quickly, the other benefit to that is, and especially if you specify you want to deal with accredited investors, is that they probably have more money.
Yeah.
So you want to have a good stable base, but if you run into problems where you need more money, you don't have to go calling externally on other people. You want to go to your investors first and say, hey, we need more money. Or if, there's an opportunity to expand the project or whatever, but you've got sort of a captive audience there that has some more reserves, and hopefully will bail you out if you need it.
Well, and usually that's what general partners do, because they're actively in the business. They're looking for opportunities. They're deploying their skills, and they're making returns for investors, right? So if they're going to come across an opportunity that meets the criteria for this set of investors, they're probably going to come across another opportunity in the next year that's also going to meet that criteria. And it'll be there's a lot of synergies there, right? Because they can go and deploy the same team on that project and make a better return because they've already experienced it. And so as an investor, once you kind of make these investments, you can scale up or down however you want. Where were we talking about?
You were talking about limited partners. Whoa, sorry.
You got to have another Coke.
No kidding.
So I guess the idea is that we're scaling up this model where you have income and expenses, and you're taking your rental income, you're distributing it. So when you scale that up to multiple people and you have a general partner, the actual term is waterfall, right?
Yep.
So how does the money get distributed in these deals, right?
Yeah, and how do you determine what is the worth of a general partner?
Yeah.
Especially so general partner
pretty low. It's pretty low.
Pretty low. The GP may have some money in there.
Yeah.
And ideally, if you're doing this, you want to see the GP with some skin in the game.
Yeah.
But it may be 10% of the project or 5% of the project, right? So they've got some money. They stand to lose if things don't go well.
Yeah.
But the bulk of the money is coming from the LPs. So then it's a matter of okay, so they're actually operating it. They do have some costs with their staff, depending on the size of their office, et cetera, et cetera. So how do you fairly compensate them for that part? And I guess that's the deal structure, and that's the art of the deal, right?
Yeah, because if the fees from the general partner are too high, then nobody's going to invest.
Yeah.
Right? And if nobody invests, then the deal doesn't happen, and they don't have a business, and the investors also don't get any return, right?
Yeah.
But if the fee is too low, then the investors get all the money, and the deal doesn't really work because the general partner is not really getting compensated. So there is a bit of a balance, and the market kind of determines where that lands, right?
Yeah, and I mean, if it's someone with staff, that deal could fall apart if they're not actually making enough money
Yeah.
to support their staff and their everything
Man, you're
else,
sounding
right?
like you're crying the blues for the general partners
A
here.
little bit, yeah.
We're on the LP side. We're
Okay,
trying to
sorry.
fight for the LPs here.
Right, for the little guy with lots of
Yeah,
money.
the little partnerships.
So yeah, that's where the waterfall idea comes in, right? You've got
And waterfall just means distribution of money that we get out of this deal,
Yeah.
right? So if you have, you mentioned you break it into two buckets. And so like one is operations, which just means, maybe operations and capital distribution. So capital distribution, let's say you sell the property
Yep.
at the end, right? Well, what happens with the money? So there's like a clear structure of where the money goes and why. And with just like an operational distribution or a cash flow distribution, it's just the regular money that we get paid on a monthly basis from this rental property or from this investment property.
Yeah.
What do we do with that money? Because it's usually like probably 100% of the time, but hopefully you get a property where the cash flow is so great that it pays all your money back. But most of the time it's just a tiny fraction of what you invested, right?
Yeah.
So you bought a huge investment property and you put hundreds of thousands of dollars in, and then you're getting like $1,000 a month. Woohoo.
Yeah.
Right. But so in reality, you're never going to be able to pay back all your investment with the cash flow, or it's
That's
going to
right.
take a significant amount of time. Right. So there's a little bit of a different model when it comes to how that money gets distributed.
But typically you will have, maybe not typically, but often you would have both distributions set up. So you would have the sort of the cash flow distribution set up, like in your contract, right? Here's how we handle the cash flow, and then here's how we handle capital, because that could be a refinance, right? If you're thinking about just like a house, a residential development, you may do a whole bunch of work and you want to hang on to it, but when you refinance, where does the money from the refi go? But then you're holding on to it and you're getting cash flow afterwards. How does that work? And if everybody's still in the deal, how does the cash flow work?
Yeah. So what usually happens? Maybe we talk about this at a high level.
Right? Talk about cash flow.
Okay.
And I mean, this could apply to the refi stuff as well.
You have a diagram there, or
I
what?
have a little diagram. Hopefully this sort of makes sense. But the idea is the general partner is incentivized to make this deal make as much money as possible.
Yeah.
So you've got different tiers of reward, basically. So using this one as an example, right? So if there's a 6% internal rate of return, so rate of return on that project, the LPs would get 95% of that. So let's say it's $1,000.
Whoa. I think
Right,
you lost me already.
Okay, so let's say initially you've got, on this first band, you've got $1,000 of income, and that equates to a 6% rate of return on the whole project. So 6%, I don't know, it's not great. So in that case, the LPs are going to get 95% of that $1,000. So if there's one LP, then he's going to get like that whole chunk of money. If there's a bunch of LPs, they split that amongst themselves based on how much they've invested. Right, so bigger investors get more, smaller investors get less. And then the GP gets 5% of that 6% return. So if he only ever this project only ever makes 6%, the GP's not doing very good.
Yeah. So
Right?
he's incentivized to make the deal even better.
So once that deal hits 8% rate of return, now just looking at this example, the GP's portion of that is now 15%. So he's getting 15% of the profits. It may be, you may tie it into like at 6% it's this, and then the next 2% to bring it up to 8% is this. And then once you hit to the third tier, so let's say you're making 12% rate of return, you just see how the GP's share of the pie gets bigger the further down the waterfall you go. And that's, if we're looking at the tiers, that's why it's the waterfall, right? so that, eventually if the project's making a lot of money, the GP makes a bigger percentage every time that project makes more money.
Okay, let's simplify this a little bit because probably lost.
I thought it was simple, Brent.
Yeah, I don't know. Kind of lost me a little bit. So, I think capital distributions might be easier to understand. So,
here we go.
Yeah. Well, because you can say, look, your camera cut out. All right. So capital distribution means when you sell the property, right, there's a whole bunch of capital, which is money. And that has to pay for stuff, right? And where does that go first? Okay, well, let's say you sold it and you made $1 million. That has to go, and you're talking about incentives, like who gets what first, right? So there's basically hurdles or waterfalls. And for people listening who weren't able to look at the graph, I think you could think of it as the money comes out of the deal when you sell it, and it goes into a bucket. And the first bucket is the first tier, the first hurdle, and that fills up. And then once it's full, it spills over into the next bucket, and then it fills that one up, right? And each of these buckets just fill up in sequence, and no money goes to the next bucket until the first one's full, right? And then eventually everything gets paid, and ideally there's so much money it just flows everywhere.
And you run out of buckets.
Yeah, and you run out of buckets. And then you come to us because we've talked about buckets before, all these reusable Home Depot buckets.
That's right.
It keeps coming back. I don't know. Yeah, shoot, I got a whole bunch in my garage. I'm going to go run around next time I see a limited partnership
you're gonna do a deal?
offering. Just going to bring my buckets with. Okay, that's funny because, when you go to these meetings, they're usually a little bit more professional than, anyways. So you sell the property for $1 million. The first thing, so let's use an example deal. I just have a sheet in front of me that is a deal that we've looked at in the past. So payment of unpaid preferred return. Whoa, that's a big word.
Here, Brent.
Unpaid preferred return. Oh, you got.
If you're on YouTube, I've got a waterfall made of buckets.
Yeah, there you go. So the first hurdle is unpaid preferred return. And this is going to be really complex for people to understand if they've never heard of preferred return before.
Yeah.
But to try and do it really simply, we want to just say when you invest money into something and there's multiple partners, and you put in more money than someone else, or let's say the other guy didn't put any money in and you put all the money in, a preferred return just means that you're going to earn money, like a percentage on whatever amount of money that you have invested in the deal that someone else doesn't.
Yeah.
Right? So in the case of a general partnership structure like we're talking about now, if you have the general partner and like they maybe say put in 10% of the money and the limited partners put in 90% of the money, and one of the limited partners puts in 500 grand and the other guy puts in 100 grand, right? The first hurdle is going to be a preferred return that's owed to these people, right? So usually it's a percentage, so it's like, let's say in this one it's 8%.
Yeah.
Right. So they're gonna, if they put in 100 grand, what's 8%? That's 8 grand. So they're entitled to 8 grand on that 100 of whatever proceeds come out. And then the next.
So the guy who put in 100 grand is getting 8 grand back. The guy who put in 500 grand is getting like 40 grand back.
Yeah. Yeah.
Yeah. Assuming there's the money.
Assume. Yeah. So the assumption there is that if the deal doesn't have the money to pay that, it won't pay that because there is no return.
Yeah.
Yeah.
No, it's just a bad deal all around.
Yeah. Or it might be early on in the deal, right?
Yeah.
That you're not, if you sell for a loss or whatever, right, then that's not good. But, in due time, if you write out the investment thesis and all goes well, then there should be adequate returns.
Yeah.
But the idea with these hurdles or these waterfalls is that bucket has to fill up for the next one to happen, and they usually put like the general partner's fees lower down so that it shows them that, hey, we're pretty confident this is going to go well. So our fees are down here and you get paid first. So
we're not going to make any money until you get X amount back
Yeah.
as an equity investor.
And so this deal,
And that's called a pref, right? You said
Yeah.
preferred return, also known as a pref.
Yeah. So if you ever hear that preferred return, preference.
Yeah.
Yeah. My preference is to make the money. And then the next thing they have on this example is like an asset management fee. So like there would be a certain percentage of the deal. In this case, it's like 0.5%.
Yeah.
They're going to take as a fee. And then the next thing is...
And that's also known as the promote?
No, that's later on in this particular case.
All right.
So just to kind of quickly run through these. So the next one is return of capital. So if you put in, if you're the guy putting in the 500 grand and you already got your 40 as a 8% preferred return, now you get your 500 back, right? So
and this is assuming that that this thing's making lots of money.
Yeah.
And there's extra money.
This is the capital distribution one. But
yeah. Okay.
So we sold the project 10 years later. We made $1 million, and you get 40 grand, you get 10 grand, and then you're going to get your 500 grand back, and you're going to get your 100 grand back, right? And that happens before, in this case anyways, the GP, the general partner, will get their promote, which is like their percentage return.
And that's typically a bigger percentage. So let's say they had 10% in. They're also getting money back based on equity, based on these buckets, but only in accordance with the money they've put in.
Yeah.
But then the promote could be a much bigger, it could be 25% of the project.
In this case, 20%, 25, 30. Yeah. It could be higher or lower. And that's all based on the risk of the deal and the competency of the general partner and all this stuff, right? The market conditions.
Yeah. So essentially, the people who put money in, if everything goes well, they get their money back.
Yeah.
And then, so we're a couple buckets down now, right?
Yeah.
And then everybody splits that money. Let's say it's $1 million, according to the next bucket. So that could be now that the GP is getting 20%. Of the deal, and 80% goes to the investors. So even though he only put in 5 or 10% of the original equity, he's getting a much bigger chunk at the end. But that's because he made that happen.
Yeah, and I think
it could be she.
Yeah, I think it's important to note that with this podcast, we're not trying to describe every kind of possible scenario. We're just trying to make people familiar with the language of a general partnership, a limited partnership, so that like if someone ever says waterfall to you, you don't just think, oh, Niagara Falls, or like oh, interesting.
Well, or the concept of prefs, right? You said that off air that people this is the biggest stumbling block for people.
Yeah, and
to understand,
it's still I bump into it all the time. But I don't even know where to start.
You don't have to. Just know this.
It's an accounting term that I'm not an accountant, but and it happens in the context of an investment, and you know, and when people get money involved, it's really like, you know, what's going on here. So it can be confusing because it is not. It's not as straightforward as, like, you can't just give it a one-word explanation. But what I'm trying to say is, with this podcast, we're just trying to make people familiar with these terms and, like, the fact that this is out there so that, you know, you hear this word, you kind of know a little bit where it comes from. And then the other thing to know, too, is that all of these different rates and ratios and stuff are not necessarily going to appear in the same order and the same percentages in every deal, right?
Yeah.
And so they're kind of like Lego blocks in the tool of the general partnership, limited partnership structure to work with, right? To say, look, okay, we want to make this investment opportunity happen, and in order to do that, the market conditions are like this right now. You know, we think we can do this with this property. So we're going to offer, maybe it's more risky, right? So we're going to offer more incentive for the investor. And one way to do that is to offer a higher preferred return, for example, right? So that the investor is confident that they're going to earn a certain rate of return on their money, like guaranteed. It's not guaranteed in the sense that if the money doesn't actually come, it's not going to be paid, but they will get paid that first before anything else happens, right? Yeah. And then same thing on the other side, like for the general partnership. So if something where the general partnership adds a lot of value and investors would just love to get into this deal, and there's so many investors that really want in on this, they can charge a higher promote because they're bringing something to the marketplace for investment product that's of really desirable, right? And then they can make a lot more money and do more of these deals and help more people. So
yeah, and that would be so. Like as an example, then if you were going to invest in this thing with a bigger promote, you would know that these guys are getting a bigger piece of the pie.
Yeah.
But that whole pie should be bigger than if I either went with this different GP on the same kind of project, or if I did a different style of deal. Like I know this one's going to make me more money, so I'm okay with paying that GP a bigger piece of the pie, provided I get my money back first. Or yeah, exactly. So who cares if they're getting
speaking
more?
Speaking of big pies, man, I could.
Yeah, what's your favorite kind of pie?
I don't know. Probably a meat pie.
Oh, I was thinking like just fruits and stuff, but meat pies. A nice, like an Aussie meat pie. Yeah. They make some good meat pies.
My wife's from Australia, so shout out to all of our, how many listeners we got in Australia?
Both of them.
Both of them. I went there, I had an Aussie meat pie. They are pretty good, I got to admit.
Yeah. But, it's one thing they do well. Grind up those kangaroos.
Yeah. Well, they got cricket. What is that? Aussie rules football or whatever.
Yeah. Okay, so back to waterfalls and GPs and LPs. I don't know. What else do you want to say on that
okay,
topic?
So there's a lot of I guess just to frame it quickly for listeners who might be looking at making an investment but not necessarily knowing if title ownership of a residential real estate in your local neighborhood is like the best thing, or like what Mark is doing, buying stuff in the States and converting it to Airbnb, but you're still going on title and you're buying it with your wife and you're going to go there with your kids and put furniture or whatever. And you're going to manage it. And obviously you have some risk, some returns, whatever involved in that. With this deal structure, you're sitting in your office or you're sitting at home around your kitchen table after work and you're going, you know what, I got $100,000. What can I do with it?
Yeah.
This is an option that's kind of in between, doing the hands-on stuff yourself, because you're basically paying someone else to do that on a larger scale and you're taking a percentage of it.
Yeah.
And then like with a REIT, again, like we talked off the top, that's like the next layer removed. And you kind of go in this, like how much control do I have over this asset, right?
Yeah.
So I think one thing to keep in mind too is liquidity. Like, how easily can you get out of this deal? And so that's really important when you think about real estate. Is most people invest in real estate because of what it does for their life, and it's a long-term investment. But when you buy something yourself, like a house in your neighborhood or somewhere, you can sell it whenever you choose. And it's not the most liquid. It's not liquid like stocks, right? We talk
fairly
about
liquid
stocks.
Though.
It's fairly liquid, and especially in a market where there's demand and whatever. But it's your decision, right?
Yeah.
And you can control it. You can list it tomorrow. With a private equity deal where you have a general partnership who's running the project, it's a different kind of commitment, right? Because you're actually signing an agreement with them and you're saying, here's my money. And you're basically saying, you're kissing it goodbye. You're saying, look, you're going to do what you said you did, or what you said you're going to do with this money. And you're going to give me this in return later. And that later could, sometimes they're open-ended, right? Sometimes it's 3 years. This is what we're going to do, but it's always 3 years plus this could happen, this could happen, this could happen, right? Sometimes it's 10 years or 5 years, right? Sometimes it's just, we're going to buy this and we're going to keep it forever. That's the intent anyways. And we're going to give your money back when the returns are such that we can refinance your money back out and give you your check back, right? So for an investor looking at this, like, I think you have to be aware that you need to have a good solid exit strategy for this deal, or be mindful that this money's kind of tucked away. It's not like a GIC or something.
You can just pull it out when you see something else shiny.
Ooh, right? I'm going to sell all those stocks and buy this stock instead, right? It's not that kind of investing.
Yeah. And you should have some knowledge of the asset or the deal type that you're doing, right? Instead of just blindly like, okay, here's
Sorry, I just saw something shiny over there.
but instead of saying like, here's $100,000 or here's $1 million, go.
Have you ever heard of ADOS?
No.
It's like the syndrome that people have now.
No,
It's
no,
like,
a new one. Okay.
Yeah, attention deficit. Ooh, shiny.
I like that one.
Okay. I think it's really, the diagnosis of that is really crept up.
Yeah.
Especially since people started listening to this.
Yeah, probably. But anyways, normally I'm the one distracted with jokes.
It's like
we
dad
flipped
joke
it.
training over here.
Yeah. I'm rubbing off on you. But yeah, you should have some idea of what the deal is about or what the type of asset that you're investing in so that you can really evaluate whether this GP knows what they're talking about as well, right?
Yeah, and there's a little bit of synergy too when you're an investor and let's say you're into farms and this is like a farm related project you're investing in.
Yeah.
Well, you can actually add value too because here's my money, but also when we sit down together and discuss, here's some insight that I have that I've experienced and they can benefit and you can benefit, right? So it's not like you're actually doing the work, but your expertise or your perspective on the industry or like the asset class you're investing in might actually be able to benefit the general partner and therefore benefit you. And it's kind of like this little trickle down. No, it's not trickle down. It's kind of
it's water. It's a waterfall.
Yeah.
It's all waterfalls and liquidity in buckets.
Yeah, money goes where it's treated best.
And then if you
It's
get
always
enough,
falling through the cracks, Mark.
well, if there's enough liquidity, you can plant a money tree and you water it, right? Talking about mixing your metaphors.
The city was going to plant the tree at one of our houses, and they gave us a list, and the ones I wanted weren't on there, and then they put it in the wrong spot, and I was like, oh, they're totally incompetent. Anyways, that's another episode.
Okay, incompetence. We'll do a segment on that. Okay, well, was that, I think that was comprehensive and confusing enough for everybody.
Yeah.
And we can maybe talk about joint ventures next time.
Yeah, this is just touching the surface of this kind of topic, but there is definitely opportunities out there, I think, for people in this space. And we, like at Good Stewards, I don't know about yourself, but we see opportunities on a regular basis doing general partnerships. And, we've deployed capital into this. We've invested in some ourselves. Mm-hmm. And it is really cool because you can kind of pick the investment thesis that you want to be involved in and get involved in a project that, I don't know, for investors that have a certain idea in their head, like I want to be involved in creating housing in this area, you can really be selective and narrow it down and find some good partners. And then you can take advantage of financing, for example, right? That's not available to you as an individual.
Right.
So there is definitely benefits to this strategy. And so we're definitely heavily looking into it and building relationships and hoping to offer that to people as well. So super exciting space.
And you build relationships with other like-minded people that you may not have met otherwise, right? So it's a cool, like real estate is all about networking. Really cool way to network as well. Yeah.
So definitely encourage people to check out this space.
Okay.
Yeah.
Well, that's great. Okay. We'll end off on a whimper, I think. And thanks for listening.
I'm going to go get some lunch.
Okay. I'm going to go get a coffee. So until next time,
steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
And if you like my voice better, click share.
If you like both, give us a 5-star rating.
To interact with the show, feel free to reach out at hello@twostewards.ca.
We'll see you in the next episode. In the meantime, steward your wealth wisely.